Let's greet you. Tom Lee, Head of Research at Fundstrat, Managing Partner, and CNBC contributor. Seeing you this Friday is a pleasure. Tom, welcome back. Scott, thank you. I'm glad to see you. I start here by pointing out that we are currently seeing the stock trend, with the S&P hitting 5,800 for the first time ever. However, based on your notes, it appears that you are becoming a little more cautious as the month goes on. Why? We're wary, but we told our clients to purchase the dips, Scott. We're cautious because, I know this is a pretty apparent statement, I believe investors want to see who wins the presidency after Election Day. In my opinion, we are currently in a phase where markets are merely sitting on the sidelines. However, 2024 has been such a successful year, Scott, that I believe the past 2 weeks have demonstrated that perhaps macro is reversing course at this time, and liquidity and all of this cash on the sidelines is actually the determining factor. Do you believe that we simply need to finish the election so that we can go on to what you still believe to be a respectable rally? Your aim, I believe, is 6,000 or so. Yes, Scott, the economy appears to be doing well, and the Fed is dovish, so there is a lot of firepower supporting stocks after the election. We're not in a recession, in my opinion. As a result, stocks have highly positive 3- and 6-month outlooks. Although there may be some hesitancy, I believe that China's government is finally beginning to implement certain policies that will help that region turn around. Naturally, the third factor is that, after 2 years, I believe investors who have been extremely conservative are beginning to understand that, the low levels of margin debt and the $6 trillion of capital on the sidelines need to be used at a time when the Fed is bolstering the economy. I believe that the other potential obstacles are those that may not fall under the political cycle, at least as it is commonly defined. They claim that valuations are overly stretched or rich. At almost 21.5, the S&P is clearly above its historical norm. Yields have increased. I believe they're still up a little bit more than many anticipated after the Fed's 50-point test, but you could argue that they're up for the correct reasons. Furthermore, is it a problem if the Fed proceeds with rate decreases a little more slowly and in smaller increments? The counterargument to that is, of course, why they would need to do anything at all. Because, as you just indicated, the economy is robust. Yes, Scott, with regard to all those things, I am aware that the S&P's aggregate number is used for valuation, but it is deceptive since, as we all know, the top 7 equities do have a higher merited multiple, and the median PE is not that much less expensive. It is about 18 times. However, given that the 10-year yield is actually a 25 P/E, it isn't a bad value. Regarding the potential slowdown in Fed rate decreases, I believe that the Fed is on track to essentially normalize interest rates back towards neutral as a result of diminishing inflation pressures. Even while this week's CPI was a bit higher than anticipated, I don't think it really indicated that inflation was picking up speed again. Therefore, I believe that the Fed's trajectory toward 3% is quite positive for stocks. I believe we could say that the consensus is bullish at this moment, so let's hope we can all sort of agree. Because of the economy and rate reduction, most believe that stocks will continue to rise. Where to position yourself to capitalize on a market that seems to be genuinely interested in rising seems to be the main point of contention among the crowd at this time. Small caps may have the chance to make the largest jump between now and the end of the year, as you have clearly indicated. That's a contentious opinion because, those equities may perform worse if yields are high. The economy is slowing down somewhat, or there are concerns about it. The insightful analysis Ricky Sandler of Eminence posted on social media yesterday, stating that the best place to play offense, and he believes you should play offense, is in below mega-cap companies with intriguing earnings equity stories at mid to large cap, not mega, but mid to large. I found this to be interesting. He doesn't mention small either. How would you counter those with your arguments? We're on the same side of the market expansion line, I would say, and he believes that mid to large companies offer a superior risk-reward ratio for a number of reasons, including the possibility. Do you agree with Mr. Sandler that he feels the need to seek elsewhere because the market at the index level is both pricey and consensus? For at least 2 of the reasons he cites, mega caps are underperforming, or at least the Nasdaq is today. Perhaps that is how the tale will ultimately unfold. In my opinion, individuals are cautious if they believe that P/A's indicate the peak of stocks. However, I believe that the P/E is increasing because American businesses and the economy have weathered a stress test. We experienced a pandemic, a worldwide trade halt, a massive inflationary cycle, and the Fed's fastest rate hikes ever. Scott, assume that businesses are making record profits as a result of the four factors that just blasted corporate profitability. They passed a stress test, which, in my opinion, justifies larger multiples. I just don't personally think 20 times for a category-leading company is pricey, even 25 times. Additionally, if we are discussing NVIDIA, the reason is obvious. I'm not sure. Yes, 30 should be the upper limit. P/E's are increasing, so I believe that's why we're feeling uneasy. But I also believe that businesses have managed to withstand 4 catastrophic stress tests. Jim, in relation to excellent foundational businesses, what about technology? We reach these all-time highs because of those names after all. Will they carry us there any longer? Tomorrow, NVIDIA will be released. All right, so let's discuss NVIDIA. I would like to send a shout out to Josh, who I believe has been in it the longest out of all of us. Perhaps even you, Jason. Look though, tomorrow's report is probably going to be excellent. There's no reason to believe that it will be any different. People can't get enough of the chips, based on what the hyperscalers are discussing, capital expenditures, and pretty much every other news item. I would advise against paying much attention to the short-term price activity. Much of this is related to short-dated options that people are wearing to play the pop, most likely following earnings, and then selling the calls, which causes the stock to decline. Therefore, don't worry about the immediate action. Regarding technology in general, I believe that people will be reluctant to sell things as the year draws to a close for the same reasons that we have all discussed earlier in the show. Once more, you don't want to accept a taxable gain, and if you're benchmarked or indexed, you don't want to risk lagging behind the benchmark. Just to connect this to what Josh was saying a moment earlier, by the way, the reason bottom fishing is currently a horrible idea is because it is the exact reverse of what I just described. The items that have been destroyed are probably candidates for tax losses. In December, they'll probably be bear mauled. You don't want to be shopping there at the moment. You've owned NVIDIA, Jason. You may have been there the longest, Jim just said. What do you create before printing? Is it too late for someone who hasn't invested at the current price action? Not in my opinion. The obvious question, in my opinion, is how sustainable this continuous demand for AI computing is. How sustainable is it?